I'm assuming yesterday when you're listening to this testimony, it validated what you thought. This is a good thing?
Yeah, absolutely. I mean, the Fed's very behind the curve. They're still adding monetary policy stimulus, even as the economy is overheating, even as the supply of labor is quite tight. So they're behind the curve, and they need to free up some space so they can actually have greater optionality in terms of the timing of liftoff. And Chair Powell's testimony today said they're going to do that at this next FOMC meeting. They'll accelerate the taper, finish it by mid-March. That means that the possibility of liftoff can start at the March meeting or somewhat later.
Even then, would they still be behind the curve? We've still got another few months of stimulus being added to the economy. Bill, how does the Fed get in front of this inflation story? What does it need to do? Does it want to be in front of this inflation story?
What's interesting about the market reaction is the markets are not acting like the Fed's behind the curve. If you look at the peak federal funds rate that the market's expecting for this cycle, it's only about 1.75% That's very inconsistent with what inflation is doing and how late the Fed is in responding to that inflation risk. So I think that the market's going to have to be significantly repriced at some point. The Fed will probably have to go faster than what people expect. They'll probably have to go higher than what people will expect. And that's going to be a bit of a shock to financial markets.
Well, Bill, that's an interesting point, because when we were discussing this yesterday, it seemed like what the market was pricing in was maybe more aggressive rate hikes, but a lower terminal rate. They just don't last as long. They don't go as high, for example. How unprepared do you feel like is the market for the scenario that you're outlining?
I think it's very unprepared. I mean, as you pointed out yesterday, it wasn't about increasing the amount of tightening built in by the Fed being more concerned about inflation. It was just pulling it forward. So there's more rate hikes priced into 2022 and the first half of 2023. But there's virtually nothing beyond middle of 2023 and into 24, 25. And the terminal rate is really, really low. So I think there's still, I think people are overestimating how easy it is going to be for the Fed to get inflation under control. The idea that the Fed tightens 3-4 times and all of a sudden inflation just melts away, I don't think that's how it's going to work. The Federal Reserve has to tighten sufficiently to essentially slow the economy to prevent the economy from overheating. And so it's going to take more than what's priced in today to do that.
Bill, we haven't had a credit cycle. Are we about to have one?
I don't think we're going to have one really in the very near term, because the Fed's still on hold for a while. The Fed is expected to tighten, moderately over the next couple of years, and earnings growth is really, really strong right now. So I think the credit cycle is going to happen, but it's only going to happen when there's a realization that the Federal Reserve has to do quite a bit more. Even the Federal Reserve itself thinks that the peak in the cycle is going to be quite a bit higher than what markets priced in. If you look at the summary of economic projections, they view a neutral short-term rate at 2% inflation as 2 to 3%, and inflation is well north of 2%. So if they're going to make monetary policy tight, they think that the rates are going to have to go well above 2 to 3%. So that's, there's a disconnect between market expectations and what the Fed thinks and what the Fed's going to have to do with respect to inflation.
Yeah, and fair enough. I mean, I feel like the markets led the Fed for the last few years when it comes to this. I want to get your take on what's happening with the long end of the curve. Today's a bit different than yesterday, but when we saw sort of the front end rate really rise and the back end did not, and flatter. The 530, for example, the flattest since March of 2020. Does this throw some cold water on the idea that the Fed is suppressing long-term rates? They have been not easing. They have been paring back some. They have been tightening those financial conditions, and yields haven't really moved.
Well, I think the hard part to evaluate is the effects of the Fed's asset purchases at a time that the Treasury's borrowing needs have actually fallen. So the Fed is taking out a lot of Treasuries from the market relative to the net new supply. And so I think we're not really going to get a good sense of where the Treasury market should actually perform in the longer end until the Fed essentially backs away from quantitative easing. And that's still 3 or 4 months away.
What is the current paradigm do you think that the Fed is operating with? We clearly probably have worked our way through a symmetrical inflation target. What comes next?
Well, the paradigm that they've been operating with is the idea that we have trouble pushing inflation up to 2%. Therefore, we have to probe the limits of maximum sustainable employment. And it turns out that was the problem of the last cycle, but that's definitely not the problem of this cycle because they're missing badly on their inflation objective currently, even as they still think there's some slack left in the U.S. labor market. So the regime that they put in place is just ill-suited for the current set of circumstances.
Something that's been happening that has been quite strange is that the job market continues to be really solid and job openings are plentiful and consumer confidence keeps rolling over. Is inflation to explain for that? What is the biggest issue?
I think inflation is absolutely how you would explain it. Otherwise, it makes little sense. Why would confidence be going down as the economy is recovering and the job markets are really robust? It's got to be because higher inflation is crimping people's disposable income, and they're feeling the strain of buying gasoline, buying groceries. Things are much more expensive than they were a year ago.
Bill, what is your global perspective on what is happening here? Is inflation a US problem? Is it a Eurozone problem? Is it going to be a problem in Japan? Because if the latter two don't see the same issues that the Fed sees, then they are going to act as a kind of counterpoint to the liquidity squeeze that the Fed is going to put on. We could potentially see the ECB and the BOJ countering that. I appreciate that globally liquidity will still fall, but nevertheless, we're still going to have two major providers in the market.
So far, Europe is following the U.S. just not quite as severely in terms of the amount of inflation pressure, but inflation has gone up quite substantially in Europe as well. A little bit less, supply disruptions because they didn't lay off a lot of workers when the pandemic hit, and so the companies haven't had to scramble so hard to get their workforce back in place. And in Japan, they're not seeing much inflation at all. So Japan is still in a very different place than the rest of the world, and that's been the case for several decades now.
Hey, Bill, before we let you go, Jay Powell yesterday made it very clear, like the next 2 weeks of data is going to be super important. You got the CPI, you have the jobs number Friday, you also have the case count if we see any rise here in the U.S. with Omicron. And I wonder, what's the number one thing you're going to be reading between the lines?
Well, I don't think the economic data is going to dissuade the Fed in terms of what they do at the next meeting. We know the labor market's strong. We know we have an inflation problem, regardless of what the next payroll employment report looks like or what the next consumer price index report looks like. The big wild card, of course, is the new variant, Omicron. And if that turns out to be, very severe, very contagious and very, severe outcomes in terms of people who get sick, could that affect the Fed's decision making? Yeah, it could. But I think as Jay Powell made clear yesterday, even if the variant turns out to be bad, it has demand effects, but also has supply effects. And it's not clear that the demand effects would be more important than the supply effects. So I think that you're pretty locked in for acceleration of the taper at the next FOMC meeting 2 weeks from now.